Welcome to The Explainer. Today, we are diving deep into one of the most powerful forces shaping our world. Yet, it's something that's, well, almost invisible. It's the engine that drives the entire economy. It's the current that moves the markets. And believe me, it affects every single dollar you earn, save, or borrow. We're talking about interest rates and the market cycle.
So let me ask you a question to get us started. What do you think is the one single thread that connects the interest rate on your mortgage, the tiny return you might get on your savings account, and the ups and downs of the entire stock market? I mean, on the surface, they seem like totally separate things, right? But they're all being pulled by the same strings. And the answer is actually incredibly simple.
It all comes down to the cost of money. That's it. At its very core, an interest rate is just that. It's the price you pay to borrow money or maybe the reward you get for saving it. And understanding this one simple idea, well, that's the key that unlocks this whole economic cycle we're about to talk about.
All right, so here's our roadmap for this explainer. First up, we're going to meet the driver of the economy and get familiar with its gas and brake pedals. Then, we'll take a walk through what I like to call the 4 seasons of the market cycle. After that, I'm going to let you in on a powerful tool the market uses to predict recessions, and it has a stunning track record. We'll make sure this all feels real by looking at some recent history, and then most importantly, we're going to bring it all back home and connect it to your wallet. So who exactly is in the driver's seat of this massive, complicated economic vehicle? Well, that would be the Central Bank of the United States. You've probably heard of it. It's called the Federal Reserve, but pretty much everyone just calls it the Fed. A good way to think about the Fed is like the economy's chauffeur. Its main goal isn't really a specific destination, but just to make sure the ride is as smooth as possible. You know, not too fast and bumpy, but not too slow either. It's constantly making these little adjustments to keep things on track. And what's its main tool? What's the main control it uses? It's something called the federal funds rate. Now, the technical definition is it's the rate banks charge each other for overnight loans, but honestly, you don't need to worry about that. Just think of it as the master interest rate for the whole country. When the Fed moves this one rate up or down, it causes a ripple effect, changing the cost of money for everybody and for everything. This is the economy's gas pedal and its brakes. So what's the Fed trying to achieve with these controls? It has 2 main jobs, and this is what's known as its dual mandate. Goal number 1, maximum employment. Basically, keep people working, keep the job market healthy. Goal number 2, stable prices. That means keeping inflation, the rate at which prices go up, low and steady, right around 2%. And right there, you can see the fundamental problem. These 2 goals are often in conflict. Hitting the gas to boost jobs can cause the economy to overheat and spark inflation. But slamming on the brakes to fight that inflation can slow everything down and cost people their jobs. It's this constant, delicate, and really difficult balancing act. Now, let's look at how this balancing act creates a pattern. It's not random. It actually results in a predictable cycle with 4 distinct phases. You can almost think of them as the 4 seasons of the year. This repeating pattern of growth and decline, of expansion and contraction, has been part of market economies for centuries. So, what are these 4 phases? They are expansion, peak, contraction, and trough. And just like the seasons, they always follow each other in exactly that order. So let's take a walk through each one and see how the Fed's actions really shape them. We'll start with expansion. This is the good part. It's like spring and summer for the economy. After the last downturn, things are growing again. You see, GDP, that's the total value of everything the country makes, it's on the rise. Businesses are hiring, unemployment is falling. The Fed's main focus here is on that maximum employment goal. So what do? They keep interest rates low. They're pressing the gas pedal to make borrowing cheap, which encourages all of us to spend and businesses to invest. This is what fuels the whole recovery. But you know what they say? Too much of a good thing can lead to trouble. And that brings us to the peak. Think of this as the hottest, most humid part of summer. The economy is now running at full tilt. Unemployment is super low, but with everybody spending money, demand starts to outstrip supply, and that's when prices start to creep up. Inflation becomes the new public enemy number 1. So the Fed's focus has to shift from jobs to its other goal, stable prices. And to cool things down, they start tapping the brakes by raising interest rates, making it more expensive to borrow money. Now, if the Fed taps those brakes a little too hard, or maybe just holds them down for too long, the economy can tip over into a contraction, which is just another word for a slowdown or a recession. This is the autumn phase. GDP starts to shrink, some companies unfortunately have to lay off workers, and unemployment starts to tick up. But as demand falls, that inflation problem we had, it starts to fix itself. So the Fed's focus swings right back to stimulating growth. They take their foot off the brake and actually start cutting interest rates again, hoping to soften the landing. And finally, we hit the trough. This is the dead of winter. Economic activity is at its lowest point. Unemployment is high. It's the moment of what investors call maximum pessimism, when things just feel bleak. But it's also right here at the very bottom that the Fed takes its most dramatic action. They often cut rates all the way to near zero, basically flooding the engine with cheap fuel to get it restarted. And it's in this dark environment, with the cost of money at rock bottom, that the seeds of the next expansion are planted, and the whole cycle begins all over again. Okay, so we know this cycle happens over and over. But wouldn't it be fantastic to have some kind of heads up before the economy is about to take a nosedive? Well, as it turns out, the bond market has this built-in warning signal. And historically, it's been an incredibly reliable crystal ball. It's called the yield curve. And I know, that sounds super technical and maybe a little intimidating, but I promise it's actually just a simple line graph. All it does is it shows the interest rate, or what they call the yield, that you get for lending money to the US government for different lengths of time. So, for example, it might compare the rate on a 2-year loan to the rate on a 10-year loan. The shape of this one simple line can tell us a ton about what the smartest people in the market expect to happen next. Now, this slide is really where the magic happens. On the left, you see a normal curve. It slopes upward. This makes total sense, right? You'd naturally expect to get paid a higher interest rate for locking your money up for 10 years versus just 2. That shape signals a healthy, growing economy. But then, look at the right. Something really weird happens. The curve flips upside down. It inverts. This is when you can get paid more for a short-term 2-year loan than a 10-year one. And that is a massive red flag. Why? Well, it means investors think the economy is so hot right now that the Fed will have to keep rates high in the short term, but that this will eventually break something and cause a recession, forcing the Fed to slash rates dramatically in the future. And look, this isn't just some abstract theory. It's genuinely one of the most reliable economic indicators we have. An inverted yield curve has come before every single US recession for the last half-century. When you see it, it's like the market is screaming through a megaphone that a contraction is probably on the horizon. Now, I know all of this might still sound a bit theoretical, so let's bring it into the real world with an experience that every single one of us just lived through: the unbelievable economic whiplash of the post-COVID era. We basically saw an entire market cycle play out on hyperspeed. Just think back. In 2020, the pandemic hit. We had a sudden contraction. The Fed's response? Cut rates to zero and slam the gas pedal. That was our trough and the beginning of a new expansion. But the stimulus and the reopening worked almost too well. By 2021, the economy was overheating, which sparked the worst inflation we'd seen in 40 years. That was the peak. So in 2022 and 2023, the Fed had to slam on the brakes, launching the fastest rate hiking campaign in decades to get that inflation under control. And that's what's led us to the recent environment, this higher for longer world, where the Fed has to keep rates elevated to make sure the inflation monster is truly defeated. Okay, so we've talked about the Fed, we've gone through the 4 seasons of the economy, we've looked at a real-world example. But what does any of this mean for you personally? Well, it matters a whole lot, because this entire cycle, driven by the cost of money, has a huge direct impact on your wallet. Let's break it down and get really practical. When the Fed is in the brake-pumping phase, raising rates to fight inflation, your mortgage and car loan rates shoot up. It just gets more expensive to borrow. But on the other side of that coin, the interest you earn in a high-yield savings account finally starts to look decent for a change. Then, when the cycle turns and the Fed starts cutting rates to fight a recession, the opposite happens. Your savings returns will probably drop, but it could be a fantastic time to refinance your house or get a loan. Your job security, it's usually strongest during the expansion and peak, and most at risk during a contraction. And of course, the performance of your 401k and the other investments is deeply, deeply tied to which season of the cycle we happen to be in. And really, that's the whole point of understanding this framework. It's not about being able to perfectly predict the future. Nobody can do that. It's about having a map of the terrain. It's about understanding the big forces at play so you can make smarter, more informed decisions with your own money. So I'll just leave you with this question. Now that you understand the driver, the vehicle, and the road they're on, take a look around at the economy today. Where on this road do you think we are right now?